Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia. Our webinar title today is Anticipating Lower Interest Rates and Potential Second Tailwind. So my name is Shin Chu. I'm the moderator for this session. So in this webinar, we are going to explore what are the prospects and opportunities in the fixed income market considering the shift in the interest rate. Now, before we begin, a disclaimer. Whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is a seasoned portfolio manager with more than 29 years of relevant experience in managing domestic fixed income investment for retail, institutional, corporate, and insurance clients. He has also gained over 12 years of experience managing global fixed income investment for institutional investors. He joined Principal Asset Management Berhad in January 2005 from CMB Debt Market and Derivative Department, where he managed fixed income portfolios of institutional clients. Prior to joining CMB in 2001, he had more than 6 years experience in fixed income investment within the insurance industry. He holds a Bachelor of Commerce degree from University of New South Wales, Australia, and is a member of the Financial Markets Association, Malaysia. He obtained his fund manager's representative license in January 2005. So he's none other than Mr. Wong Lok Chin, who is a seasoned portfolio manager with Principal Asset Management Berhad. So thank you for joining our session today, Mr. Wong. How are you today?
Hi, thanks, Shane. Doing all right.
All right, cool. So we will just hand over the session to you.
Sure. Okay. Thanks. Good evening, everyone. Hope you all have your dinner. Yep. Usually, I'll do this kind of presentation in the afternoon. So I think this is a bit of a different scenario where I'm doing it during the evening period, lah. Before I'll go on with the outlook with regards to the fixed income market. Perhaps we could actually just explore what happened early part of the month, right? Shane, if you could turn to slide number 4, please. Sorry, the next one. Next slide, please. Yep. Okay. Anyway, on the 5th of August, I guess everyone was a bit shocked, looking at the volatility of the market, where we saw equities market fell, bond yields fell as well, right? That was basically on Monday itself, right? What triggered those volatility? I think there were a few factors, right, affected those kind of volatility. I think first of all, we saw Bank of Japan raising interest rate to 0.25% from 0.1%, and also they halved the bond purchases in terms of their QE for the next 2 years. I think the other factor that triggered was the NFP number, basically the employment number, non-farm payroll number for the month of July came in lower than expected, right, for the US market, right? And that actually resulted in a concern that the employment number is actually slowing down more significantly than the market expected. The other thing also, the unemployment number actually ticked up to 4.3%. Market was only expecting about 4.1%, right? That have basically resulted in the market potentially pricing in a hard landing in the US. And also, there are investors perhaps pricing in a recession in the US market as well, right? That eventually triggered a tsunami of sell off in the equity market, and also strong buying interest in the bond market, right? As they are basically pricing in more cuts by the Fed by the end of the year, right? If you recall, during the June FOMC meeting, the Fed members were only projecting 1 cut by the end of the year, right? But of course the market was looking at 2 cuts, lah. But because of the event or the data that came out during that week, the market is pricing in close to 5 cuts, right? If you turn to slide number 9, please. Perhaps I could actually just share with you what was the situation. The next one. Yes, this one. If you look at the this particular slide, right, you can see that the top dotted line was when FOMC had their meeting in June, where they were only projecting 1 cut by the end of the year, right? And of course, the futures market on the 29th of July were looking at perhaps about 2 to 3 cuts lah. But on the 5th of August, the market actually, pushed the expectation lower, right, on the green line itself, where they were looking at potentially the Fed funds rate will be at 4% by the end of the year, right, and then potentially another 100 basis point cut in 2025. That actually caused the market to panic. I think one of the reasons why the big sell-off in the equity market was because that obviously if there's a recession, right? Typically, when there's a recession, equity market will be the one that will get hit more as compared to the bond market lah. And of course, you saw the bond market rallied significantly, right? So that actually was the reason why I think the market was actually fearing U.S. recession coming, which would eventually cause global recession as well lah. But I think after the past 1 to 2 weeks, we saw the more improvement in the US data. We saw the retail numbers actually came in better than expected, right? That eventually resulted in some cooling, some correction in the bond market, and some rebound in the equity market, right? Yeah. Maybe turn back to slide number 5. Yeah. Another thing to also do take note also, because of the BOJ recent interest rate hike, that has also caused some unwinding of the yen trades, right? As you all know, Bank of Japan has been maintaining its interest rate low, negative interest rate or close to zero for the longest time, right? More, I think more compared to the US market, the US Fed lah. Right, that eventually has caused a lot of yen carry trade, where a lot of the investors actually borrow yen and invest into other currencies, lah, right? And because of the unwinding, or sorry, um, because of the interest rate hike, but in Japan itself, we actually saw a lot of unwinding of the yen trade, lah. That also caused the yen to actually rally, right? At one time it was about 160, now dealing about 147 to the dollar, lah, right? That also have actually resulted in the ringgit to strengthen as well, right? Eventually, right? Next slide, please. So what has and hasn't changed, right? First of all, the Fed most likely will increase the pace, right? As I mentioned earlier, they were looking at just 1 cut by the end of the 2024 in the June meeting. But looking at the current situation, the backdrop of the economic data that was released over the past 2-3 weeks, we believe that the Fed may actually change its tone in the next meeting in September, where we probably will see about 3 cuts by the end of the year. That is basically priced in by the market anyway, right? And because of data which are going to be released over the next few months, we still expect market volatility to continue, right? But do take note, in September itself, before the FOMC meeting, there will be a labor market number, NFP number, to be released early part of September. And there will be also the CPI number, inflation number, in the middle of September that will be released. So the Fed will obviously want to monitor those closely in terms of those data before they actually decide in terms of the quantum of rate cuts, right, towards the end of the year. Right. But overall, we still believe US economy to be on track for a soft landing, right? If you turn to next slide, please. Okay. On the macro assumption for the second half, first of all, we know U.S. economy is going to be going through a soft landing, right? I think due to the cooling of the labor market, because of the tightness of the credit conditions, due to the higher interest rate, that has resulted in a slowdown, right, in the U.S. Meanwhile, in China itself, recovery continues to be uneven, right? That basically the key lies in restoring corporate and household confidence, as well as basically trying to address the property market challenges lah. Now we know inflation is basically slowing down in the US, but it's still a bit sticky, still above 2%, which is above the 2% target that the FOMC wanted lah. But overall, the base case is that we will be seeing the inflation to fall closer to the target. But whether it's going to be year end or early next year, I think it's waiting to be seen, lah. Right. But China, of course, is going through a inflation difficulty. We are seeing that they are in a deflationary environment, lah. So obviously, potentially, we may see China to going to cut rates further as well, lah. Hence, I think in terms of the cut rates further, yeah, for China. Now, for central bank in the US, we already indicated that it's going to be a 3 cut of 25 basis point for September, November, and December. And also, this will also basically depends on the data, right, coming out over the next few months. ECB has basically made its first cut in June, but likely there will be more cuts as well, right? As a result, obviously, US dollar is going to be weakened. As we saw, dollar has been weakening. The DXY index has actually weakened quite a fair bit following the NFP numbers that came out, and also the weaker inflation number that came out 2 weeks ago. Right. Next slide. This is basically the expectation of the US real GDP growth, right? We know the second quarter came in at 2.8%. Our expectation is for the third quarter and even the fourth quarter to be at 1.5% quarter on quarter, right? Unlike I think earlier, the market was basically looking at a negative growth for the third quarter, right? Maybe if you could turn to slide number 11, please. Now, going into Malaysian market itself, we saw the central bank actually released the second quarter number last Friday. Our real GDP growth actually came in better than expected, right? The advanced number early part of last month was released at 5.8%. But last Friday, Bank Negara actually released the second quarter real GDP growth to be at 5.9%, right? This is basically driven by, first of all, construction and services, right? That have actually grew much higher compared to the first quarter, right? And also consumer demand, domestic demand has been the main driver for the local economy as well. So in a way, market consensus is probably looking at the real GDP growth for 2024 to be slightly above 5%, right? Some consensus are looking at 5.2% because of the strong number in the second quarter. Right. Now for inflation, next slide, please. The next one, please. Inflation is another concern. I think first of all, we have to understand Bank Negara has a dual objective, right? One is actually for monetary stability. The other one is financial stability, right? And inflation is obviously one of the data that Bank Negara monitors. More importantly, core inflation, right? The June inflation actually came in at 2%, right? Less than the market expectation of 2.2%. This is obviously despite the removal of the diesel subsidies, right, in the month of June, right, where the market was expecting a slight tick up in terms of the inflation number. But the fact is that the June number actually came in line with the May number at 2%, right? Now we will want to monitor what would be the increase for the month of July and obviously August, right? And that would be what the government be looking at as well, because first of all, I think they are still looking at the timing to implement the RON 95 subsidies removal, right? That would actually be the big kahuna, basically, in terms of reducing the fiscal or the funding requirement, right? So as such, I think Bank Negara, or rather the government, would be very cautious in terms of timing the removal of RON 95 going forward, right? Now, based on the backdrop of the growth expectation for 2024 and also the inflation expectation for 2024, we do expect Bank Negara to maintain its OPR at 3%, right? I think for the rest of the year, even for the first half of next year as well. I think firstly, we don't foresee core inflation to be a concern. The other thing will be GDP growth remains very stable. Anything above 4.5 to 5% seems to be the number that what the Bank Negara would want the growth to be. Okay, next slide. Okay, we do know that the government's target is to actually reduce fiscal deficit, right? We had a very high fiscal deficit since the pandemic, right? From 6.2% to 6.4%. Now it's actually potentially going down to fiscal deficit of 4.3% in 2024. I think first of all, the government is actually trying to reduce it to around 3 to 3.5%, right? By I think in order for the government to actually reduce the fiscal deficit, first of all, they have to actually implement some form of policy reforms, right? Subsidy reforms. That's what they've been doing in terms of the diesel. Hopefully, they'll be able to actually implement the RON 95 as well, and that is actually potentially will provide a base for the fiscal deficit to be reduced. Now, the only concern is that we've heard about the government is implementing, or rather increasing the government servants' salary, right, by the end of the year, likely to be announced in the budget 2025 in October. Now, what could actually happen is that there'll be, the government would need higher funding to actually fund all this increase in terms of the salary, right? So in a way, I do believe they would have to actually implement the RON 95 subsidies to actually be able to fund those kind of increase in terms of the salary. Otherwise, it's a bit difficult for the fiscal deficit to actually be on target at -3% or 3.5% by the end of next year or 2026. That was the government target. Right. Next slide. Okay. For the bond market in Malaysia, right? First of all, we know Bank Negara has actually raised the interest rate to 3%, right? Since last year. Now, we do believe that the yield it remains attractive, right? Despite the higher issuances of bond in the Malaysian market, right? And if you look at the yield differential, right? More importantly, those double A's and single A's, it's still hovering above let's say averaging about 27 to 50 basis point, right? Depending on what rating we are holding, and that actually will still provide a higher total return as compared to where we hold the MGS, right? More importantly, if you look at the overall yield pickup from a bond market itself, we are still able to garner close to about 4% to 4.5%, depending on what sort of rating that we have, right? And the other thing also, if you turn to next slide, please. The ringgit bond market is mainly supported by the local institutions, right? So you can see that the domestic holders, right, comprising close to about 80%, comes from banking institutions and EPF, right? Foreign holders are holding close to about 20%, which is still significant. But obviously, I think they see our ringgit market to be fairly attractive, and because of the liquidity in the market, provide them those kind of trading opportunity lah, right? I think more importantly is because of the yield pickup as compared to a lot of our regional countries yield. For example, Thailand, right, which is yielding close to about 2%, right? So I think that's basically one of the reasons why our bond market has been very well supported, right? Firstly, because of our local investors, local institutional investors, and also the foreign holders, lah, right? Okay, next slide. This slide is basically just to share with you, when there's a start of interest rate cut, right, cycle, is actually a positive catalyst for bond market, right? You can see that over the past, I think, 20 to 30 years, where we saw the peak of interest rate, and potentially when there's a cut, we will see a slightly better total return when there's a rate cut, lah, right? As you can see from let's say 1980, right, when the Fed cuts, the bond market actually returned about close to 35%. Now for 2018 itself, the bond actually returned close to 12%, right? So on the table on the right itself, just want to share with you, Malaysian market has been very stable, has been well supported, right, as compared to the global market, right? You can see that the Malaysian on the year to date has delivered about close to 3.05%, right? As compared to you can see that US is only been able to deliver about 1.34%, whereas for UK it's actually negative return, right? So in a way, Malaysian market is basically insulated from a lot of the volatilities, right, globally. And I think first of all, because our interest rate is fairly stable, fundamentally our economy is also stable. Inflation remains benign. So I think that is actually a positive sign for a lot of fixed income investors. Okay, the next slide, please. Now, if you look at the next slide, I just want to share with you historical performances of, let's say, a government bond index and a corporate bond index during the past 15 years. And when you compare it with the table on the right, which is where the interest rate environment was, especially our OPR, right? Now, if you look at the period when it was between 2011, right, to 2019, when OPR was capped at 3%. There were times that Bank Negara actually hiked it to 3.25, but eventually it came down to 3%. So what I'm trying to say is that as long as interest rate remains close to 3% and stable, we do expect bond market to deliver a positive return, right? Now you can see that on the middle table itself, the corporate index, right, the corporate all bond index, right, from 2011 delivered about 5.5%, up to 2019 about 8.59%, right? That basically indicated that as long as Bank Negara remain or kept its OPR at 3%, overall bond performance or bond return will be able to deliver close to at least 4 to 5% on average, right? This is an indication that as long as we have bond yields above close to 4%, bond return should be able to deliver at least 4% as well, right? Now, when there's a cut, obviously interest rate cut, and you can see in 2008 to 2009, we do expect bond perform a much better return. But the problem is that when Bank Negara hike interest rate, right? For example, in 2020 to 2022, right? We do see the 2021, 2022 return is only 0.3% in 2021 and 1.64% in 2022. That was basically during the period where market was expecting Bank Negara to hike interest rate, right? But of course, back in 2023, the bond actually delivered a very strong return of 7.7%. And year to date, 2024, up until June, bond has actually been able to return about close to 2.7%. Right? So this is an indication. So in fact, the conclusion is that as long as we have the interest rate at the peak at 3%, bond yields should be able to actually deliver those kind of return, right? Okay, next slide, please. Now, I just want to share with you this particular chart, right? First of all, this is basically a chart in terms of performance since 2018. Now you can see that 2018 itself, the red bar depicts the KLCI. The blue bar is basically the ringgit all bond index. Yellow is basically the Asian credit, and green is the global aggregate index, right? What we can see here is that the ringgit market has always been able to deliver a positive return, except for, let's say, 21 and 22, right? We know what happened in 21 and 22, where I think market was expecting interest rate to rise. Hence, overall, all asset class delivered negative return, right? But what I'm trying to also indicate is that over a period of let's say 6 to 7 years, in terms of cumulative return, right? Ringgit bond has been able to deliver close to 34%, right? 34%, as compared to the Asian bond, which was only 21%, right? Whereas global bond was negative 3.5%, while KLCI was down 9.5%, right? KLCI only, I think, come in stronger this year, right? If you look at 2024 year-to-date July, the KLCI actually delivered close to 12%, whereas for ringgit bond market was about 3%. So what I'm trying to, explain here is that as long as you, have a balance of, investment, I think more importantly, have investment into our ringgit bond market. In the longer run, we should be, the fund, or rather the bond market, ringgit bond market, should be able to deliver, a positive return, and is actually able to provide a stable and less volatility as compared to the other asset class, right? And lastly, slide 19. Next slide, please. I think for now, moving into, I think, 2025, or rather, and towards the end of 2024 and 2025, I think looking at the current Malaysian market, our equity fund managers are positive with regards to the equity market in Malaysia. And then we are also, in terms of the ringgit market, ringgit bond market is also positive. So we have been actually, aggressively promoting, investors moving into balanced fund, because I think that's where I think the investors should be able to actually get those kind of higher total return, right, coming from equity market because of the growth stocks, and also income coming from the bond market, right? So I think if you look at this chart itself, when there's a severe downturn, right, the balanced income is able to actually, provide a less volatility as compared to aggressive or growth domestic strategy, right? You can see the purple line is quite volatile as compared to the yellow line, right? So by investing into a balance, you may be able to get, a higher set of return as compared to fixed income as well, right? So in conclusion, the next slide, please. So why do we invest in fixed income now? I think firstly, yields are attractive now because it has actually peaked in terms of interest rate, right? Like I already indicated earlier, right? With the OPR maintaining at 3%, most of the bond performance should be able to deliver close to about 4 to 5%, right? And income, secondly, is income. More importantly, because investing into bonds do provide coupons, or rather profit for Sukuk, right? These are paid regularly on a 6 monthly basis, and we are able to actually distribute those coupons or interest income as dividend income, right, for the fund. For fixed income, as I also indicated earlier, it is actually stable, right? It has been, fairly stable, less volatile as compared to other asset class throughout the those kind of market cycles lah. Although we do once in a while deliver close to 0% return, or rather 1% return, like we saw in 2021 and 2022, but it does come back strongly, right, over the next couple of years lah, where on average basis, we should be able to deliver at least a 4 to 5% return, right? And lastly, duration. I think exposure wise, currently because of the yield pickup, I think our preference is actually to invest into longer duration to provide those kind of yield pickup, and also potentially we never know, right? Bank Negara may actually one day cut interest rate because of a slower growth and falling inflation, right? So from the drop in the interest rate, potentially there will be capital gains that we can actually be able to garner from it. Yeah. I think that's basically what I am trying to promote. Investing into fixed income to be able to get those kind of stable income on a regular basis. Yep. I think I'll pause there for any Q&A. Or back to you, Shane.
All right, thank you so much, Mr. Wong, for sharing with us about the prospect and opportunities in the fixed income market, given the shift in the interest rate hike, in the interest rate policy by the Federal Reserve. So, if you have any questions, ask our speaker today. Please write your question in the Q&A box. Okay, not the chat box. Write them at the Q&A box. So, I've seen a number of questions on the Q&A panel now. First question is by Ng Zilun. So, Mr. Wong, how do you see the carry trade activities in the Japanese market? Have the unwinding action been completed?
Okay, that's a good question. I think it's a bit difficult to gauge whether the unwinding has been completed because over the years, over the past, I think 10, 15 years, when BOJ has been keeping its interest rate close to zero, and I think a couple of years at negative interest rate, I think there are a lot of yen carry trades, right? There are reports saying that it's close to about 500 billion US dollar, right? But basically these are reports lah. I don't think we are able to actually gauge what is the size and whether the unwinding has been completed lah. Like I mentioned earlier, I think with the uncertainty going forward, we will still expect volatility, right? The volatility will also be impacted by the unwinding of the yen carry trade, right? So I think it's a bit difficult to gauge whether it's been completed or not in terms of the unwinding of the yen carry trade. Yeah.
All right. The next question is by Lily. If the US is going to cut interest rate by 0.05% for the next 3 months consecutively, but in the meantime, Malaysia maintain the interest rate at 3%, will this unchanged fiscal policy bring any opportunities to the Malaysian economy?
Yeah, good question. Okay, first of all, I must say, any changes to the policy rates in the US, typically there's a very small form of impact to the Malaysian market, in particularly our fixed income market, right? If you if you excuse me, if you look at the historical data, right, when US rates were negative and our OPR was positive, in terms of in terms of the differential of the MGS yields and the US Treasury yields, US Treasury yields were basically below MGS, right? But there was still demand for MGS market, right? And also looking back at prior to the financial crisis, US Fed funds rate were also above 5%, and Bank Negara actually maintained its OPR around 275 to 3%. That also didn't actually affect our bond market as well. So in a way, I don't think there's a correlation with regards to US rates being below our OPR or even above our OPR. So as long as for Malaysia itself, we have to monitor our fundamental. First of all, our GDP. All right, this is basically what Bank Negara wants in terms of the dual mandate, the growth expectation, and the core inflation. As long as these are within the expectation of Bank Negara, we can actually see that the OPR will actually be quite fairly stable.
Thanks, Mr. Wong.
Yep.
So the next question is by Eugene. So he want to ask, for your opinion, as a young person, should we invest in bonds? Because usually bonds are come with lower risk, and hence better for those who are a bit more risk averse. But young person have longer time horizon, and we can stomach more volatility. So what's your view?
You see, personally, I would recommend investors to actually diversify their investments. First of all, yeah, I do agree. For bond investment, the return is not as high as the equity market. But of course, bond market or bond fund provides a low volatility as compared to equity market. As you saw earlier when I provide the performance of the bond as compared to KLCI. KLCI only provide or deliver the positive return in 2024. But whereas for bond market, it has actually been delivering positive return across the past few years, right? So in a way, I would rather advise that investors diversify their investment. Basically, like I mentioned earlier, also it's actually good to invest into a balanced fund, right? Because balanced funds, you are able to actually um, invest into both the equity and also the fixed income classes, right? Where potentially equity would be able to deliver those kind of positive return, better return as compared to the bond fund. But also the element of fixed income in the balance fund also will provide those kind of dividend or income that the fund can actually provide. Yeah.
All right, thanks, Mr. Wong. The next question is by Ang. So when the Fed wants to cut interest rate, is it because of a potential recession on the horizon? If so, will the market drop?
Yeah, I think very crucial question, right? First of all, the Fed is basically, I think, same like Bank Negara. They have a dual mandate. I think more importantly, the FOMC members monitor the inflation very closely, right? I think over the past 1 to 2 years, the Fed has been looking at inflation number more closely compared to the employment number. Because employment number has been very strong over the past 1 year, right? It's only recently we saw some softening, right? So their target is actually for the inflation to reach 2%, right? Because they have a certain mandate before they want to cut interest rate. It doesn't mean that the US is going into recession, that they want to cut interest rate. It's not because of that. I think more importantly because they are looking at the inflation to actually moderate closely to the 2% target before they want to start easing the monetary policy. So what we are seeing here is that, okay, first of all, the inflation number is really going closer to 2%, but it's still higher than that. But secondly, more importantly, employment number, the labor market has seen an uptick in terms of unemployment, right? In the US, right? Labor market is seeing a slowdown. I think that is some of the data that the Fed is a bit worried, right? Because of those data that actually just came out 2 weeks ago. This is what I think the market is probably trying to price in, that the FOMC will actually cut interest rate, right? But I mean, the issue of whether they're going to cut interest rate on a gradual basis, or it's going to be aggressive manner, it all depends on where the growth expectation will be. I think what who is it? Stan. Is it Stan? Or Alex? I think the question is that
No, this by Ang.
if, or by Ang, sorry, if the US going to see a recession, right? I think the potential of US cutting aggressively is there, right? So I think like what we initially I think saw in the first week of August, right? As I also indicated earlier, the market was actually pricing in a US recession. They actually were pricing in a hard landing in the US economy. I think that's why they were actually basically looking at more than 4 to 5 cuts this year, and this is why the equity market actually collapsed, right? But eventually, like I mentioned earlier, right, there was a reversal in terms of the expectation of the U.S. economy, right? Now I think the market realized that it's not recession, it's not hard landing that the U.S. economy is going to be having. Hence, the market is basically slowly repricing the interest rate cut to around 3 cuts by the end of the year. So as such, as long as we see the US FOMC, gradually cut interest rate, both the asset class, equity, and also fixed income market will actually be, more or less perform, right? The only concern is that, if there's going to be a recession, yeah, then the FOMC have no choice but to cut aggressively. That would actually be, negative for the equity market.
Right. Thanks, Mr. Wong, for sharing your take on this. There's one question from Deb. His question is on if the interest rate is cut, the US may have difficulty selling their bonds. And also, Democrats need to look good before the presidential election. So, what do you think about that? Will a rate cut is a definite thing in September?
Yeah, I think that's a very tricky question. I think first of all, we know U.S. Treasuries, who are the main buyers, lah. First of all, I think foreign investors are the main buyer of the U.S. Treasuries, right? Namely the Japanese government and also the Chinese government, lah, right? So in a way, when there's a rate cut, obviously U.S. Treasury yields will actually drop, right? And whether there's going to be demand for the U.S. Treasury yields, I think it all depends on the demand for the U.S. market as well. So I cannot actually gauge whether there will be lack or slow demand for the U.S. Treasuries going forward because of the lower interest rate. It's a bit difficult to answer those that question.
All right, understand. Thanks, Mr. Wong. The next question is from Lily. Just now you mentioned that our government has objective to reduce fiscal deficit with all this kind of reform. So what benefit will it bring to the Malaysian economy besides seeing the positive impact on the fixed income market?
Okay. Okay. First of all, you know that fiscal deficit, is basically a deficit in terms of funding requirement, right, by the government as compared to the expenses that they need to make, right? And over the years, the fiscal deficit is looking to actually narrow, right? And the purpose is actually to reduce funding on all these unnecessary expenses, right? And also, by reducing those kind of expenses, by reducing the deficit, the funding requirement by the government will also be reduced, right? And that would eventually, reduce the debt of the government as well, right? And by reducing the deficit, as you all recall, Fitch actually downgraded Malaysian sovereign rating, right, to a single A minus back in, if I'm not mistaken, 2021 or 2022, because of the higher deficit, right, due to the higher funding requirement, right. So I think that's one of the main policy by the federal government is actually to reduce the fiscal deficit, and one of the reasons is actually to install our credit rating as well, right? So with the Fitch rating potentially upgrading, or potentially other international rating agencies upgrading our rating because of the strong performance of our fiscal balance, we could actually see more foreign investors coming into our market, right? And that could also result in our ringgit to perform much better as compared to I think over the past 3 years. Yeah, I think probably you are seeing that our ringgit has been fairly strong over the
Yeah.
past 2 weeks, right? Right. So I think the other one of the reasons is because our second quarter GDP has been actually stronger than expected, right? And I think the government is doing the right thing of trying to reduce the fiscal deficit by introducing the diesel subsidies reform, right? I think that is a positive factor that is also basically driving some of the fundamental for the ringgit strengthening.
All right. Thanks, Mr. Wong. Mr. Wong, we know that you are a fund manager in the fixed income market. There are several questions on the equities market. I'm not sure whether you have done adequate research on the equities market. So the first question here is that I'm not sure if, as an asset management firm, do you have a target for FPM KLCI for the end of 2024?
Okay. I think we do have. I do believe it's about 1,007 lah, if I'm not mistaken. I because like you said lah, I'm not the equity fund manager, so I don't have the data. But I think coming from my equity colleague, our target is basically about close to 1,007 lah.
All right. Thanks for sharing your view. With the
Yeah.
projected US interest rate cuts, will we see an increased uptake in the Malaysian equities?
Okay, another question on equities, which I
Yeah.
don't think
All right.
I shall be actually answering that question lah. So sorry.
Okay, no problem. I think there are a lot more questions on the equities, so I guess we will restrict it to the fixed income market.
Sure.
Moving forward, Mr. Wong, what do you foresee the market outlook for local and foreign market? So this is by Jane Liu.
Which particular market are we talking about, the fixed income market, or
I think we will comment on the
the
fixed
overall
income
market,
market.
is it? Or for the fixed income market lah. I think as long as, for me lah, as long as interest rate remains at this current level at 3%, right? And as long as our fundamental continues to be strong, and also ringgit remains stable, we could actually see the local bond market to actually strive lah, right? If you look at the historical number as well, for me, as long as we see the interest rate, or rather OPR, to remain close to about 3%, it's actually a very attractive asset class to invest into for fixed income in the local market, domestic market, right? First of all, we are able to actually deliver higher return as compared to FD, right? And most of the funds are able to deliver or rather distribute income on a regular basis, right? I think the other thing is also, a bond fund is basically, it's like I mean, more or less, provide liquidity for you lah, for investors, right? Whenever you need money, you just have to do some withdrawals or redemptions, right? So the liquidity are there as compared to you lock into your FDs, right? Where FDs return is low, but whenever you need the money, any withdrawals, there will be penalty lah. Right. So in a way, I do believe the local market remains very attractive. Now, for the foreign bond market itself, it all depends on what type of currencies that you're holding lah. Right. If you're talking about you're investing, let's say a dollar, Aussie dollar, or maybe a pound sterling bonds fund, but you are investing using ringgit. Obviously, with the ringgit strengthening, it's not really palatable, right, to invest now, right? Because whatever that you gain from the capital gains from the bond, you probably lose out from the currency, right? Unless you hedge your currency position, right? Now, otherwise, if you have, for example, a dollar investment, or maybe those other Aussie dollar, or Aussie dollar holdings that you want to invest, yeah, definitely, I think it's actually a right time for you to invest into those kind of current foreign currencies bonds lah, because that is where, like I mentioned, interest rate is really at its peak. You know, most of the central banks are looking to cut interest rate, and this is where you can actually obtain those kind of capital gains or total return from the lowering of interest rate by the central banks.
All right. So that's all the time we have with Mr. Wong today. So thank you so much, everybody, for tuning in for the session today. So let me just quickly do a closure for this session. So for all of you who are keen to explore more funds, you can visit this link or scan the QR code to visit Bursa Fund platform. Okay, Bursa Malaysia also provide access for you to get into funds. So you can scan the QR code or click the link that's just given you in the chat box to go to this Bursa Fund platform page. All right. So for our next webinar, it is titled Charging Forward, an Investor Guide to the EV Market Landscape. It is happening on the 1st of August 2024, which is tomorrow, 8:30 to 10 p.m. So if you're keen, you may click on the link that I've just given you in the chat box. All right. So thank you so much to Mr. Wong for sharing with us about the fixed income market, what are the prospects and what are the opportunities given the shift in the interest rate policy. All right. Thank you so much, Mr. Wong.
Thanks everyone. Thanks, Shane. Okay, yeah. Happy investing. Bye.
All right. And thanks everybody for tuning in. So we will see you in our next Bursa webinar. Bye-bye, everybody.